Is the Trump trade now the recession trade? Carol Schleif of BMO Private Wealth. First, give us some context. Where does today's steep stock market sell-off rank in your experience as an investment manager?
It is nerve-wracking to watch markets go down by a couple of percent in a day, but my career spans back to the 1987 crash when, for perspective, the Dow the Dow declined 23% in a single day. So this one still ranks up there as very concerning anytime markets are down with this amount of vehemence, if you will, especially on unexpected news. It's worrisome, but it also is worthwhile remembering as investors that reacting in this, especially being pushed into trying to react emotionally, is never a wise long-term decision.
Investors were looking for some clarity on tariffs, but have we sort of entered an even deeper level of uncertainty?
I think that's a very astute question and observation because we have been seeking clarity all year. Uncertainty is that overused word. When I hit the thesaurus looking for a different word, there's not many other words to use other than uncertainty. And you exacerbated a lot of that yesterday. I think you, number one, took markets by surprise in terms of the depth and breadth and the dollar or and the sheer percentage amount that many of these tariffs were applied at. But that issue of the markets desperately want to have it settled so they can focus on the next thing that they want to focus on, and this is anything but settled because a lot of the way it was put out there leaves wiggle room for negotiation, which just means this has the potential to drag on.
And as this has the potential to drag on, do you see this as potentially now pushing the US into a recession?
That's not our house call at this point, and it's really important to remember a lot of the fundamental underlying positives that were going on in the US economy, but also in global markets. Because when you looked at year to date coming through into yesterday's announcement, especially through the end of the first quarter, many global indices or non-US indices were actually up for the quarter. They performed very strongly this year. Bonds were up, gold is up. There's a lot of different trades and positions out there that have performed pretty well. But the US economy itself entered into this period in pretty solid shape where you had GDP growing at 2.5%, 3% for many years. You had productivity growth that was strong. You were starting to see some turnover in sentiment surveys because of that uncertainty that we talked about. And yet, a lot of times that so-called soft data doesn't translate into the hard data. And as of yet, we haven't seen it impact the hard data. So the whole kerfuffle, if you will, around tariffs has come at a time when the US economy was on very solid and sound footing. And I think President Trump and his team has counted on the fact that the US economy is so strong as a base for being able to reorient and reboot the way we do manufacturing here.
You mentioned, of course, that investors shouldn't panic. But if they're thinking about where do I run for safety, where do they run for safety?
I think one of the important things is to the extent your portfolio has been balanced, maybe look at the bond portion of your portfolio, look at some of the non-US portions of the portfolio, run an analysis that way in a calculation and realize that pretty diversified balanced portfolios, even through the end of the first quarter, were pretty flattish, up a little bit depending on what you were doing. So I think focusing on that and focusing on the fact that you're still getting yield in cash and shorter term securities, and there are potential positives to this. I spoke to a group of mortgage bankers yesterday who are very keyed into that 10-year rate. And to the extent that they can keep confidence in their consumers about making a big ticket purchase, you really ought to see a lot of activity in the housing market, especially moving into the spring period, because a 4 or a 4.1% 10-year realistically ought to put a lot of pressure on that 30-year mortgage or the 15-year mortgage. So hopefully there's some positives to glean out of this. And another positive to potentially take is the fact that now that the tariffs are out there, the administration, the key people like Scott Bessent and Howard Lutnick can be working with Congress to get tax relief passed, into the impact of if there's some very pro-business tax proposals out there in terms of accelerated depreciation. And I've even heard one floated that would allow for more rapid deduction of capital expenditures in terms of people putting up plants quickly. So to the extent that we can get people focused on the growth aspects of what this administration is trying to do and away from these irritating tariffs and the opaqueness they cause, that could cause a narrative change in markets too.